Hey everyone, me Kevin here. In this video, we need to talk about 8 massive catalysts for July. If you are investing in the stock market, you need to know about all 8 of these. And no, it is not that the programs on Building Your Wealth have an expiring coupon code on July 28th. You already know that. That would be redundant. That would be just as redundant as saying that 70% of the S&P 500's market cap reports by the end of the month. At this point, that's obvious. We already know that the prices on the courses on Building Your Wealth are going up, and we already know the value increases exponentially with the prices. Instead, let's talk about catalysts. Catalyst number 1 is GDP, and boy oh boy do we have a lot to talk about GDP. Gross domestic product, when it comes in at a negative read for 2 quarters in a row, we are technically in a recession. Now, there is still a Bureau of Economic Research that technically needs to define that yes, we are indeed in a recession. They don't necessarily use the technical definition of recession. They define a recession by a significant decline in economic activity that is spread across the economy that lasts more than a few months. And generally they look at a few things like depth, diffusion, and duration. And generally what they're looking for is a big weight on personal incomes and employment figures. But folks, I don't know how many people actually care about the National Bureau of Economic Research and their opinions, aka these suits' opinions as to whether or not we're in a GDP recession. I think what markets are going to look for is, look, Q1, folks, Q1 of 2022, we had negative GDP. I don't care what the number is. I don't care what the suits say. If Q2 comes in with a negative GDP read, we're in a recession. We are in a technical recession, and folks are going to freak out. Mostly the mainstream media. My expectation is you're going to have sort of the Tucker Carlsons and the Anderson Coopers trying to figure out ways to blame why we're in a recession. You know, you'll have Anderson Cooper suggesting that it's Mitch McConnell's fault and it's Joe Manchin's fault, and Tucker Carlson will say it's Joe Biden's fault. You know, it's and of course Nancy Pelosi's fault. You know, it'll be just the typical. But on July 28th, we're actually going to get that GDP read. So mark your calendar for July 28th. That's the same day as that coupon expiration. But that's a big one. Now remember, the economy did shrink slightly in Q1. So again, a slight negative read over here means we're probably technically in a recession. Kind of tough though to even consider that we might be in a recession, given that we just added 372,000 jobs in June, which seems pretty remarkable. But you know, it's this kind of uncertainty that's also leading to some crazy estimates. In fact, if you are a bear, you're probably already familiar with the Atlanta Federal Reserve's estimate of GDP. In fact, if you just jump over here, you'll see that the Atlanta Federal Reserve suggests that for the second quarter, we are probably seeing negative GDP to the tune of negative 1.5%. See where this circle is down here? This is the suggestion of where GDP is based on sort of current indicators. And if I go ahead and draw a line here at that 0% level, you can see anything below it indicates that we're in a recession. And you can see this really started over here in kind of, Q2 really starts right over here. And you can see we sort of bobbed at the beginning of the quarter around potentially negative, but we certainly fell negative here in June. And or rather in July right here we were still slightly above it, which creates somewhat of a potential argument that, okay, well, maybe the second quarter will actually be spared, because again, if I draw the second quarter here with a red line here, and I'll draw a red line right about here, you can see it looks like we really turned negative with the Atlanta GDP, either slightly right here, but certainly here in July. Now, this creates a little bit of an issue, because if we have a Q1 negative read, but then we have a Q2 positive read, and then we have a Q3 negative read, technically that's not a recession. That's problematic. We're not consistently growing, but it's not a recession because we don't have 2 consecutive months of, 2 quarters of consecutive GDP declines, right? Now, bears like to use the Atlanta Fed estimate of GDP. Bulls like to use the St. Louis Federal Reserve's estimate of GDP, which right now actually sits for the second quarter at 4.11%. So you could see how like either manipulated or just off estimates are, given that Atlanta for Q2 has us sitting over here nearly negative. And the St. Louis Federal Reserve doesn't even have us going negative once over here, not even presently here as of July 15th. So it shows you the numbers are a little bit skewed. The fact of the matter, though, is it just highlights the importance of July 28th. So mark your calendar for this day. It's a very, very important day. It's GDP read. It will determine whether or not we're in a recession or not. It's coupon expiration day, so it could be a double sad day because prices go up and we might be in a recession, which is kind of remarkable. Okay, so that's the first most important catalyst. And I would certainly say that is by far very, very important, though we do have some other quite strong catalysts. The second catalyst has to do with housing starts. Those actually come out today, 7/19. We are expecting 1,580,000 housing starts. We'll have that number around the time that this video comes out, so you'll be able to see the headline news on this, and we'll see what kind of housing starts we get. Housing starts are really important because they're sort of a leading indicator as to what home builders are thinking about the real estate market. Home builders, if all of a sudden we see a big miss in this, and let's say we got a number like 1.2 mil, could be sort of an indicator that, oh no, home builders are really concerned. If we get a beat, then that could be a sign that home builders think, hey, the housing market, sure, we might, housing market may have boomed, we might slow a little bit here, but we're gonna go off to the races again. And housing starts are a good leading indicator to try to help us understand what do we think could happen in the housing market. So housing starts, those will come out today. Pay attention to those. 7/26, we will be getting consumer expectations. Quite important to see what consumer sentiment really is and their expectations for business development, though probably not going to be as important as the catalyst on the 27th, which on the 27th, we're going to get retail inventories. Now, this is a pretty important number that we will also get some insights from through earnings, right? Remember that you can go to the balance sheet of any company, and you can see the inventory increase quarter over quarter or year over year, and it's quite fascinating to see the transition in how much inventory companies have. Very, very important because this can become very deflationary, or I should say disinflationary. Remember that inflation means that this is a 0% line where prices stay stable. Inflation means that prices are above that, let's say a 4% increase here, so a positive 4%. And if we get disinflation, that means that prices are slowing down their increase. Maybe now they're only increasing at a rate of about 2%. And then of course, deflation would be a decline in prices. Now, do keep in mind, and this is probably one of the most important things to think about inflation, and this is something that actually makes inflation somewhat difficult to stick around. A lot of folks like to say, oh no, inflation's going to be here forever. We're just going to keep seeing these inflationary rates. It's very, 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 very difficult for that to actually be true. And there's a particular reason for that, and it has to do with base effects. So what that means is, if you have a $100 widget that sells for $100 today, and next year it sells for $110, well, how much was the inflation rate? Well, in this case, the inflation rate was 10%. If the year after that, the product was also selling for $110, then in this case, the inflation rate was actually 10% compared to 2 years ago, but year over year was actually 0%. And now if we see inflation go to, let's say, 105, well, now we've actually had negative, it's slightly less than that, it'd be like negative 4.9% inflation. And so we've actually now seen deflation in this kind of example. So here you would have no inflation. This would be deflation, which is prices going down. And then disinflation is another example here where that $110 product the next year goes to, let's say, $112. And even though it's slightly less than this, just to make math simple, that works out to approximately a 2% increase. Well, disinflation means instead of having 10% inflation like we had here, we now have 2. So when you go from 10 to 2%, that's disinflation. When you go from 10% to negative, that would be deflation, right? And then obviously inflation is continuing to see that number increase. And inflation is exactly why on the 27th, we're also going to see massive movements in markets because it's FOMC day. On the 27th, we will get a decision from the Federal Reserve in terms of how many basis points to actually hike interest rates. We have a lot of estimates in terms of where the terminal rate is going to be for the Federal Reserve. The terminal rate is sort of the end point in terms of how much people believe or markets believe that the Federal Reserve is going to increase interest rates, be that 3.75% or 4%, which are roughly the current estimates, before the Federal Reserve begins to soften again and brings those rates back down to maybe more accommodative levels around 3% and eventually closer to a longer run average, which the Fed is trying to achieve, of about 2.5%. Now, the Federal Reserve right now is also going to likely have to give us a lot of commentary on whether or not we actually think that commodity prices coming down and inflationary costs coming down in energy are going to affect the future outlook of the Federal Reserve. In other words, put sort of a slightly different way, if the Federal Reserve comes out and says, hey, we're seeing all these commodity prices fall, we're starting to see disinflation, we're seeing inventories build up, then that could be seen as the beginning of sort of a Federal Reserve U-turn. And that could be priced into the market very, very nicely by rewarding long-term investors. If the Federal Reserve says, you know what, we're seeing these disinflationary signs, but they're not enough yet, we need to be hawkish, then we're going to get a stronger rate hike and we're going to get a more hawkish and verbal Federal Reserve telling us that the fight isn't over. We might see some prices coming down, but so far inflation is broadening, which it did in the last CPI report. It's rising, which it did in the last CPI report. And if anything, it's getting worse, and we need to make sure that we prevent a wage price spiral and service-based inflation, like insurance is going up for cars or health insurance is going up because costs for labor or whatever are going up. Right now, the Federal Reserve is expected with a 63.8% probability to hike by 75 basis points. And there is a 36.2% probability that we actually see a full 100 basis points or 1 percentage increase in the Fed funds rate. This would leave the federal funds rate at 2.25% on the low end or 2.5% on the low end if we get that full 1%, which goes to show that if we're trying to get to 3.75 to 4, there's still quite a bit of tightening to do at the Federal Reserve. And so this idea that the Federal Reserve is ready to U-turn anytime soon is a little bit hopium-based, but it's also built into this idea that, well, markets are going to try to price in that future U-turn somewhere around 6 months before it actually happens. So even though the Fed might still have 6 months of tightening ahead, if markets are already assuming that the Fed is going to loosen their trajectory at some point in the future, then markets will potentially start a bull run or at least a relief rally substantially before the Federal Reserve actually U-turns. Although, and this is important to remember, that's not actually what happened in 1987 when the Federal Reserve first set the precedent of bailing out markets. It's not what happened in 2003. It's not what happened in 2009. It's not what happened in 2018. And it's not what happened in 2020. In other words, in all of these years, it actually took the Federal Reserve actually U-turning, not just talking about U-turning, for markets to bottom. In other words, markets did not bottom until the Fed actually U-turned and accommodated the markets by stimulating the markets. Of course, many folks today say, don't worry, this time is different, though the four most dangerous words in investing are, this time is different. But what's not different is that you can get life insurance in as little as 5 minutes via the link in the description down below. Go to metkevin.com/life to learn more. Okay, the next thing that we have is, that's on the 27th, that is at 11 a.m. Pacific Standard Time, and then at 11:30 we will have comments from the Federal Reserve. The very next day we'll have that GDP report, because mark your calendars, this is going to be 7/27. The next day you get GDP report and coupon expiration, and then on the 29th we're going to get a number that the Federal Reserve very actively pays attention to, and it is the University of Michigan Consumer Sentiment and Consumer Expectations Survey. So far, we've actually seen inflation expectations not only anchored, but they, in the last read, rotated down. We want to see that continuation of either stability or rotation down, because if this survey comes in hot on 7/29, expect markets to go red, because that's usually what turns the Federal Reserve hawkish. The last thing the Federal Reserve wants is for inflation expectations to become anchored. Folks frequently ask me, Kevin, how is this different from Paul Volcker in 1979, 1980, 1981? The difference is very, very simple. It's one word. It is expectations. That's it. Expectations of the bond market's measures of inflation, which are usually the 5 and 10-year break-evens. Don't worry so much about that. But consumer expectations also critical. Follow for more. Make sure to subscribe. Check out the programs on building your wealth. And thanks so much for watching. Bye.